Asian equities are set to fall after a coordinated move by some nations to release reserves did little to stem oil price fears. Treasuries slide, with traders expecting just one Fed cut this year. Oil extending gains as President Trump touts the release of emergency oil reserves and says the US is prepared to finish the job in the campaign against Iran.
Hello and welcome to The Week Ahead on Nomura Podcasts. I'm your host Andrew Ticehurst from our Global Markets Research team, and today is Thursday the 12th of March. Well, markets have remained fixated with oil prices and developments in the Middle East this week. We've seen a lot of mixed headlines, and you heard a little snippet there from Heidi Stroud-Watts from Bloomberg, noting oil prices moving higher through the middle of the week, despite news of the release of record oil reserves. Fresh headlines have been coming thick and fast, and that sets a tricky backdrop for a bunch of central banks which will be meeting and delivering policy announcements next week, with a key uncertainty being that the duration of this conflict is unknown. This week, you'll be hearing from key members of Nomura's global research team, Jeremy Schwartz in New York, Andres Szczepaniak in London, Yuban Parajueles from our Singapore office, and Yachiro Nozaki from Tokyo. I want to get their thoughts on how they see their regions being impacted by developments in the Middle East and how central banks might respond. Now, we are recording this podcast a little earlier than normal this week, and the global backdrop is very fluid. But with that qualification, let's dive in. Okay, so let's go to the US, and I'm very fortunate to have Jeremy Schwartz, senior economist from our US team based in New York, with me. Jeremy, thanks for coming on once again. I wanted to start with your latest thoughts around oil and Iran and how that's shaping your thoughts about the US economy right now.
Yeah, sure thing. So again, the Iran situation remains extremely fluid. I think there's a lot of uncertainty still over the administration's objectives. Increasingly in recent days, we've seen Trump seeming to be looking for an off-ramp for the conflict, a potential way to de-escalate. But at the same time, it takes two to tango, and it's not clear that the Iranian side is prepared to kind of step down their provocations in the region. So I think it's highly uncertain how long this goes on. In terms of the energy price impacts for as long as you kind of continue to be dealing with this bottleneck in the Strait of Hormuz, the U.S. is impacted, but I would say substantially less than most other developed economies. First off, the U.S., of course, is a net energy exporter. We have ample domestic supply of crude, sufficient domestic refining capacity. So we don't really depend on barrels from the Middle East in any way. The price of oil is still going to be a headwind for U.S. consumers. But to the extent that you do get a long-lived increase in energy prices, that actually has a positive offset because that tends to incentivize domestic production and investment. U.S. shale drilling has a relatively fast investment cycle. It can be one of the most reactive sources of global supply to price increases, which can, again, help to offset some of the growth headwinds. At the same time, the U.S. is relatively insulated from global gas markets. So the U.S. has ample domestic natural gas supplies and relatively little interconnectedness with the rest of the world. So there's about 15 billion cubic feet per day of export capacity through LNG, but that's really just a small fraction of the US markets, and it doesn't tend to be very elastic on the supply side. So even when you have a shortage like what we're seeing globally, there's really no way to have the rest of the world bid away the US supply, which means that most of the production remains captive domestically, which means you're not going to get very much pressure for natural gas prices for residential users. You're not going to get too much pass-through into electricity prices. And actually, somewhat perversely, to the extent that you do get incentives for more shale oil drilling, that actually creates more domestic gas supply as a byproduct, since a rising share of U.S. natural gas is actually produced associated with oil drilling. So again, there's no pass-through. There is some headline inflation impact, obviously to the extent that you get additional supply pressures in things like fertilizer or metals, that can have some inflationary impact as well. But unlike other economies, which are truly dependent on Middle East supply and are going to deal with acute price pressures, the US consumers and businesses are kind of relatively well insulated.
Okay, got it. So look, I thought the other big theme, I guess, which will be attracting increasing attention over coming days, is the FOMC meeting next week. Now, we are recording this a good couple of days out, but that oil Iran situation complicates the backdrop, I guess. So question for you, what are you expecting from the Fed next week? What are the key things we should look out for?
Yeah, so again, the decision for the Fed to stay on hold has been pretty well telegraphed at this point. There are likely to be a handful of dissents from dovish governors, but the majority of voters clearly think policy is in a good place here. And what we've seen in the data recently is maybe a return to some of that stagflationary narrative, the view that there are risks to both sides of the mandate. Obviously the disappointment in the February NFP report is going to bring some of those labor market concerns kind of back to the forefront, even after it looked like the situation had stabilized for a few months going into the start of the year. At the same time, though, it's getting harder and harder to ignore some signs of lingering inflation pressure. So the CPI report for February was relatively mild on the headline and core numbers, but the details suggest you're going to get another very strong core PCE reading in February. And at this point, you're going to have, we expect, a third consecutive 0.4% month on month for core PCE. And that's not just backward looking at this point. In addition to the potential disruptions from the Middle East and global energy prices, you're also increasingly seeing signs of global memory shortages, potentially pushing up prices of consumer electronics. There's risks that some of that can get into the auto sector as well. And you had the earlier rise in commodity prices, particularly industrial metals, which were quite strong through the end of last year and into 2026, which we think can pass through into goods prices as well. So a lot of signs of building inflationary pressure, nowhere near of the magnitude of what we saw in 2021 and 2022, but sort of a similar feel of a lot of things happening at the same time, all pushing in the same direction. So we think the Fed will be very cautious about that. We think they retain their easing bias for now. They kind of hold serve, change as little as possible about the policy communications, but increasingly acknowledge these two-sided risks and kind of insist that they're prepared to act as needed.
Got it. Good one, Jeremy. Let's leave it there. Thanks so much.
Yeah, thank you.
Okay, so turning to Europe, I'm joined here by Andrei Stepaniak from Nomura's London research team. Hey, Andrei, thanks for joining. I always enjoy chatting with you.
Hey, Andrew, thanks. Likewise, it's great to be here.
Thank you. Now, I was just speaking of chatting, I was just chatting earlier with Jeremy in New York, and he was noting that the US economy would be relatively less impacted from this Iran oil uncertainty. But I understand it's a bit of a different picture when it comes to Europe.
Yeah, look, pretty much, essentially. I think, firstly, already we have in mind the sort of 2022 European gas crisis. And it's important to sort of bear in mind, actually, the sort of correlations between, say, crude oil prices and natural gas prices relative to the various components in the inflation basket. The correlation is quite high. If we sort of zone in on crude oil prices, it's actually a very high contemporaneous correlation between Brent spot prices and this component we call fuels and lubricants. Now, the weight of this component is pretty small. It's about 4%, but large swings driven by volatile changes in crude oil prices can add markedly to headline inflation. So if we go back to March of 2022, so the start of the European energy crisis, Brent crude oil rose by about 21% month on month. And the fuels and lubricants component consequently rose by about 16% month on month. So essentially, this contributed about 0.6 percentage points to headline HICP, to the monthly pace for March 22. Now, if we're looking at sort of for the sort of data at the moment, we do think March inflation for 2026 will also be heavily impacted by the rise in crude oil prices we've seen so far. Essentially, we're thinking actually it could be about 0.4 to 0.6 percentage points higher relative to the baseline prior to the conflict. Obviously, this sort of the caveat there is we don't know how oil prices will move in the coming weeks, so bear that in mind. But at the moment, just sort of highlight, we've actually raised our 2026 HICP inflation forecast for the euro area by exactly that, by 0.6 percentage points to average 2.7% this year. One final point to note in the UK, actually, the pass-through is slightly less because an important element of fuels and lubricants, or petrol actually, is tax. And so the change in crude oil prices reflects or impacts only the underlying product cost, whereas the tax is essentially a buffer to some extent.
Okay, got it. Wow, you're across all those details. Hey, they sound like relatively large short-term moves, big swings with such large swings in oil. I guess, of course, the question is how sustained all these moves are going to be. And look, I guess this is bringing the ECB into light. They're meeting next week, of course. How do you think they're going to interpret recent developments? And what sort of message do you think we'll get from the ECB next week?
I mean, that's a great question. From the ECB's perspective, it really depends on the extent to which essentially the recent moves are persistent or the recent upward shift in futures curves are actually realized. Look, if the futures curves jump further, let's say from the current levels, and then drop back down by the end of March, the medium-term impact on the real economy is quite limited. Whereas if the conflict endures for much longer, that's when the ECB might start to get anxious in some respects. So it's worth obviously setting out, we expect no change in policy at the upcoming March meeting. I think everyone's very much in the same sort of camp. But in terms of the forecasts, we think they might be stale already to some extent. The key focus is really going to be on scenario analysis and any sort of sensitivity analysis to how inflation and growth might differ under different assumptions for oil and gas futures. People will be watching that very, very closely. It's worth noting markets obviously pricing rate hikes at the moment for the ECB for this year and next year. And we think there's clearly the risk, and we've written about this, that the ECB could raise rates this year in response to the Iran conflict, should the conflict endure. Essentially, there are sort of two rationales for the ECB to raise rates if they did do so. The first being because the medium-term view on inflation has changed owing to the conflict. But for that to occur, the conflict would have to last much longer. So that's not really the rationale for the ECB to raise rates if they did at some future meeting this year. The second sort of rationale would be in terms of an insurance rate hike to essentially make sure inflation expectations do not de-anchor. And already we've had some ECB speak talking about this, but from our perspective, the June meeting would be the earliest point at which the ECB would consider this. And so there's still time between now and then to ascertain the extent to which you see March, April, May HICP inflation impacted by recent moves, and also the extent to which inflation expectations do de-anchor or not.
Yeah, look, that's just so interesting, that sort of idea of insurance hikes, even in the face of a negative sort of growth shock. It's just so tricky, I guess, for central banks with, the various data points pulling them, growth and inflation, in different directions. Now, look, final question for you, Andre. Bank of England is also meeting. If we do a sort of ECB versus BOE contrast, is there much of a divergence there? What do you expect from the Bank of England?
Look, in terms of the Bank of England, obviously they're also very concerned about the Iran conflict and how this could impact inflation over the medium term. It's worth bearing in mind the ECB is obviously they have rates at neutral. The Bank of England was still in its cutting phase. So prior to the conflict, actually, we had expected a March rate cut. We've now actually pushed that back to April. The question mark there really is whether or not we see April eventually see that rate cut, or if we have to push back our view again if the conflict endures for longer. We think recent market volatility and uncertainty will really make the Bank of England be slightly cautious in that respect.
Okay, understood. Yeah, that's great, Andre. Let's wrap it up there. Thanks so much.
Thanks, Andrew. Great as always.
Now, Now let's swing down to Japan. I'm joined here by Yuichiro Nozaki from our Tokyo-based research team. Nozaki-san, thanks so much for joining. We're talking oil and Iran this week, and we're discussing the impacts on the various countries and regions. I understand Japan's an oil importer, so that's an interesting one. How are you seeing the macro fallout or the macro implications from these global developments?
Hi, Andrew. It's great to be back here. For the time being, the main concerns are upside inflationary pressure centered on energy and its impact on household consumption. On the other hand, Japan has ample crude oil reserves, so for now, the effects on production activity is likely to be limited. This week, we updated our economic outlook in light of the sharp rise in oil prices. In the new projection, we now expect core CPI, all items excluding fresh food, for FY 2026 to come in at 2.6% year-on-year. We had previously expected inflation to stay below 2% during 2026, but now we think it will be above 2% again by mid-2026. Of course, this outlook could move up or down depending on how long the closure of the Strait of Hormuz continues and oil prices remain elevated. We've slightly lowered our forecast for GDP growth in 2026 to 0.9%, but our view that growth will continue to exceed potential growth has not changed. As for wage increases in 2026, labor unions have already submitted their demands and companies are currently preparing responses. For that reason, impact of higher oil prices on wage settlements is unlikely in the near term. Consequently, it is hard to see underlying inflation, the inflation measures which the BOJ focuses on, being pushed up immediately. Rather, remaining uncertainty is a reason to postpone for the BOJ to next hike. As a response to higher prices in the near term, the government could take some measures to suppress energy prices. Prime Minister Takaichi says the government is considering use of contingency fund, so it will not directly lead to the additional JGB issuance.
Okay, so slightly lower GDP growth, but higher inflation and a possible government response. Lots of moving parts there, lots of uncertainty. And I guess that creates a pretty tricky backdrop for the Bank of Japan, which of course is having a policy meeting next week. What do you expect from the BOJ?
I expect the policy rate to be unchanged in the next meeting. The BOJ is still in the phase of assessing the impact of last December's rate hike, and this view is in line with the market consensus. There are two main points to watch. First, whether the number of rate hike votes increases, and second, how this situation in the Middle East assessed. Around the time of the meeting, companies' responses in the spring wage negotiation will hit their peak. If strong wage settlements keep coming in, hawkish board member Tamura could switch to supporting a rate hike. Secondly, even taking into account the rise in oil prices, I don't expect the BOJ's assessment of the economy and inflation to change materially at the March meeting. Governor Ueda will signal that he is watching developments in the Middle East closely while maintaining the policy stance of continuing rate normalization. Given the ongoing uncertainty, he is likely to avoid comments that would signal a rate hike at the April meeting.
Okay, very good. Hey, Nozaki-san, thank you so much. So much uncertainty out there. I really appreciate you coming on and sharing your thoughts with us.
Thanks, Andrew.
Okay, so finally, we're going to have a quick look at the broad Asia region. I have my friend and podcast co-host, Yuban Paraqueles, here with me. Now, Yuban, you're in London, you're traveling. I've been traveling this week too, and now we're kind of meeting up on the ether, or in the cloud, I guess. So we're talking Iran and oil. And I know you've been engaging with a range of investors in Europe. Are you getting colour? What sort of feedback are you picking up so far?
Yeah. Hey, Andrew. Morning. Thanks for having me. Yeah, it's been a bit chilly here in London, or at least chilly for my liking. And yeah, I've had a few meetings since the start of the week, and I must say it's been pretty interesting. Unsurprisingly, the most dominant topic is really on the implications of the situation in the Middle East. But I must say as well, I don't sense that investors are really very concerned or panicking already about this. It's more like they're taking it in stride. There's a lot of questions and uncertainty about the end game. But I think my sense from talking to clients is they don't see this as a prolonged war. Some have even argued that the conflict could end in a few weeks for a whole range of reasons, like TACO, or there is the Trump-Xi meeting at the end of the month. That's also been cited. And then just the logistics of it all. Somebody will run out of missiles, particularly on the Iran side. So yeah, a little bit more taking it in stride, which was, again, a bit surprising to me. And yeah, so far, knock on wood, I haven't had any cancellations in meetings, which was something I feared.
Yeah, look, it's been interesting. I might jump to my side. So I've met up with half a dozen investors here in Australia. And I would say sentiment here is starting to turn. And this is coming to light with the RBA meeting down here next week. So we had some hawkish communication from the RBA Deputy Governor, and people are thinking about high oil prices, and people have been definitely moving in a hawkish direction down here. It's now a consensus view that the RBA will deliver a rate hike next week. We at Nomura haven't shifted our call. We have to concede it is a very close one now. But we're saying 60% probability the RBA announces an unchanged cash rate next week. I think people are legitimately worried here. Inflation's been above target for a long time. High oil prices is going to further delay the return of inflation to target. But, I guess what I'm thinking is that this is going to be a negative hit to sentiment. It's a negative supply shock. And just with so much uncertainty around, the RBA might sit on their hands at this meeting, talk a bit hawkishly, but sit on their hands, certainly reserve the right to hike in the future. We do actually have another rate hike coming in Australia, but not until May. So I think they might prefer to see some resolution, gain a better understanding of what's going on with respect to Iran and oil, but then hike, maybe down the track as things settle down and they get that more of those inflation reports. But that's RBA. I guess keeping it in the region, there are other central bank meetings to look out for as well. I know, looking at my calendar, Bank Indonesia and CBC in Taiwan are meeting. What do you think they will be thinking? Could we see any action there?
Yeah, I think both central banks will be on a hawkish hold. So for Taiwan, as you know, this is an economy that continues to do well. So there's really no need for them to think about providing more accommodation. So they're going to keep the policy rate unchanged. Where they could be a little bit more on the hawkish side is their projection. So we're expecting them to raise their 2026 GDP growth forecast quite substantially, again, which is remarkable given all the uncertainty externally. But that's primarily from the fact that Taiwan really benefits from this whole AI-driven pickup in investments. And then, there'll be some impact from the increase in oil prices. So we think they're going to revise up their inflation number. But again, relatively modest, nothing too sharp. In terms of Indonesia, obviously this is a central bank that is still worrying a lot about FX stability and this increase in geopolitical tensions in the Middle East is something that obviously threatens that. So I think they will stay on guard and keep things unchanged. But where I think it could be interesting to watch is really the tone of BI, because they have been in the past few months pretty dovish, even though they were not changing the policy rate, basically suggesting that they have room to cut rates because of inflation and growth needs some support. This time around, I'm not sure if they can still say that. I think they will err on the side of caution. I think this situation in the Middle East could create a little bit more pressure on the balance of payments, which is something that's already been ongoing with headlines from the Fitch negative outlook and Moody's negative outlook as well. So I think it'd be a little bit less dovish this time in terms of the tone for Bank Indonesia.
Okay, got it. So that's interesting. I guess just wrapping up, we've got 3 central banks in our region, Indonesia, Taiwan, Australia. We're not looking for hikes next week from any of them, but I think in all 3 countries, we think the tone's going to be a bit more on the hawkish side. Yuban, thanks so much for joining amidst all your meetings. I hope they go well. Safe travels and good luck for the week ahead.
Yeah, thanks, Andrew.
Okay, so there you have it, our views on major market themes and what to look out for next week. This podcast has been written by Andrew Ticehurst and Nomura's Global Markets Research Team and expertly edited and produced as always by John Dalton. Thank you for listening in. If you did enjoy this podcast or would like to hear more, please like and subscribe to Nomura's podcasts on Apple, Spotify and SoundCloud or wherever you go for your podcasts. And if you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log into nomuraconnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.